Welcome back to Investing Talk Podcast.
Today, we are deep diving into a really specialized corner of the biotech market. We're doing a critical analysis of Bionano Genomics.
BNGO.
That's the one. And for you, the listener, the core idea here, the investment thesis, really revolves around this major business model transformation.
And that transformation is all about their tech.
It is. It's driven by their proprietary optical genome mapping technology, or OGM.
And the OGM tech is really why we're having this conversation. I mean, it's what promises this superior high-resolution detection of what they call structural variants.
The really complex, large-scale changes in our DNA.
Right. Compared to the older, almost blurrier methods, it's their main competitive edge.
Absolutely. A great way to think about it is traditional cytogenetics is like looking at a really low-resolution map. OGM gives you the 4K blueprint.
Okay.
And the big shift for the business is moving from just, selling that expensive instrument one time.
The classic razor and blade model.
Exactly. They want to become a high-margin, consumable, and clinical testing provider.
That sounds like a powerful pivot. We are definitely going to look at the numbers backing that story up. But first, we want to hear from you. As usual, before we start, subscribe, like, and comment to this video to support the show and make sure you never miss one of our deep dives into the markets. Okay, let's unpack this transformation, starting with the financials and the core fundamentals. If the story is about acceleration, what does the revenue picture actually look like right now?
Well, the revenue picture is exactly where the risk and the opportunity really meet.
How so?
If you only look at the headline number, the preliminary full-year 2025 revenue, it came in between, say, $28.4 million and $28.6 million.
Which is not great.
No. That is flat or even a slight year-over-year decrease. And that, frankly, is what's keeping this valuation so compressed.
That deceleration is the ammunition for the bears, right? They'd argue the technology just isn't getting adopted fast enough.
That's absolutely true, but you have to zoom in to see the real progress. The acceleration that's driven by this pivot, it's really clear in the quarterlies.
Okay.
Q3 2025 revenue was $7.4 million. Yeah. That was up a solid 21% year-over-year. And that growth was specifically driven by record flow cells.
And the guidance is pointing up, too?
It is. The preliminary Q4 2025 revenue guidance is set even higher. They're targeting $7.8 to $8.0 million. So this shows the pivot is working operationally, even if the big annual figures are lagging a bit because of the transition timing.
Wait, hang on. For our listeners who might not track biotech consumables every single day, what exactly is a flow cell, and why are record sales of this one item such a key indicator?
That's a fantastic question. The OGM system itself, that's the razor. The flow cell is the high-margin razor blade.
Got it.
It is the consumable cartridge that holds the patient's sample, and it's required for every single test they run on the machine. So when they report selling over 30,171 flow cells, that's not a one-time sale.
That's recurring revenue.
It's recurring revenue tied directly to usage and clinical output.
So those flow cell sales are basically a direct measure of how much these systems are actually being used in labs? Where's that growth coming from?
It's pure expansion of their footprint. I mean, they installed 32 new OGM systems in 2025. That brings their total global installed base to 387 systems.
And that installed base is sticky.
It's absolutely critical because it locks in the demand for those high-margin consumables. The more systems they have out in the field, the more flow cells they're going to sell, period.
Hey, let's cut right to the hardest part of the story, though. The current burn rate. The market cap is tiny, just $19.46 million. And we have to face the fact that the trailing 12-month net income is negative $74.33 million.
Oh.
That is a substantial annual loss.
Oh, those are significant losses. And they're exactly why the valuation is so low. It reflects the execution risk involved in trying to scale new technology.
But is there a light at the end of the tunnel?
There is. The forward-looking trajectory is improving and fast. Analysts are projecting that the 2026 losses will narrow dramatically.
How dramatically?
They're expecting them to be cut almost in half, down to negative $38.59 million. That projected efficiency gain tells us the business model pivot is actually reducing the cash burn and that they are slowly moving toward profitability.
If the financial house is still being repaired, the competitive advantage, the moat, has to be just overwhelming to justify that kind of risk. You mentioned the OGM tech. How deeply entrenched is it?
The technological moat is, I'd say it's ironclad. specifically because of the clinical validation.
The studies.
The studies.
Yeah.
At the recent AMP 2025 conference, we saw 13 studies validating OGM's utility across major areas: cancer, inherited disorders, reproductive health. Labs are integrating this because it provides answers that traditional methods simply cannot.
Which creates high switching costs once they're in.
Very high.
But that adoption, that whole pivot, it hinges entirely on the economics, and that means reimbursement. That's the real game changer here, isn't it?
It's not just a game changer. It is the critical economic catalyst that completely resets the entire investment case.
Okay, so what happened?
The category ICPT code 81195, its reimbursement rate for 2026, is increasing by a monumental 47%. It's jumping from about $1,260 up to $1,853.22 per test.
That percentage jump is massive. But
Yeah.
why is that specific code so important?
Because that code, 81195, it covers the standard clinical testing procedure for hematologic malignancies.
Blood and bone marrow cancers.
Exactly. This is a high-volume standard of care test. So by increasing the payment rate by 47%, OGM testing becomes immediately and significantly more profitable for every single clinical lab in the country.
So it forces faster adoption.
It deeply entrenches OGM as the new standard. That one decision provides a massive government-backed tailwind for all of 2026 revenue. So we've established this operational shift and the fundamental catalyst of the reimbursement code. If we connect this to the bigger picture, the charts are beginning to reflect this massive fundamental shift, even if the price volatility suggests the market is still a little hesitant.
So what are the charts telling us about the potential scale of this move? I mean, we are trading right around the $2 level, but the 52-week volatility is just extreme, right? It's ranged from a wild double of 50 cents up to $28.12.
The market is seeing two things at once. It's seeing the current financial pain and the future blockbuster potential. The average analyst price target is $7.67.
Which implies what from here?
That implies a potential 281.59% upside from where we are today. The street is basically signaling that the fundamentals, specifically that CPT reimbursement, are about to crash into the technicals, and that could lead to a huge re-rating of the stock.
But I have to be the skeptic here. Why is the market sending such wildly different technical signals? You have those long-term 2026 targets that are super high, up to $7.45, but then you also see short-term bearish forecasts predicting downside pressure to $1.47.
The divergence is classic. It's what you see in a biotech stock that's waiting for an inflection point. Right now, the indicators are just showing consolidation.
So it's neutral.
It's neutral. If you look at the technical oscillators, the RSI is at 43.26 and the SDOCH at 68.99. Neither is screaming overbought or oversold. The stock is just coiling. It's waiting patiently for the next positive earnings report that confirms the flow cell sales and that CPT ramp up.
So it's paused, waiting for confirmation.
Exactly, reflecting that split decision you pointed out.
We did see a recent volume spike, though. It went up to over 837,000 shares after the preliminary earnings previews, which suggests heightened interest. What about the smart money? Is institutional capital confirming this bullish story?
Absolutely. And this is where conviction becomes visible. We saw 41 institutional funds increase their positions last quarter.
41?
Yep. That kind of cluster buying activity indicates that the smart money is looking past the current $2 price and all the short-term noise. They are basing their position on the multi-year trajectory on that proprietary OGM platform, and that confirmed 47% reimbursement tailwind.
Moving beyond the charts, what's fascinating here is the market's psychological reaction, the sentiment. If the financials are still hurting this badly, how is the overall street scoring this company?
The quantitative sentiment scoring is actually leaning firmly positive. If you weigh it across the major news headlines, the reimbursement increase, the Q3 growth, all the analyst notes, the sentiment averages out to somewhat bullish.
Which is pretty incredible given the losses.
It's a very powerful indicator that the market really believes in the pivot.
What are the specific catalysts fueling that positive tilt? It can't just be, a feeling. It has to be concrete news.
It is entirely concrete. Number one, undeniably, is the economic driver of that 47% CPT reimbursement hike. That changes the profitability of the entire platform overnight.
Okay.
And number two is the clinical credibility from those 13 successful studies they showcased at AMP 2025. That gives them the scientific validation they need for broad adoption. And this story has clearly captured the attention of the analysts who track this space every day.
So what's the consensus look like? Are we seeing broad support for this multi-year thesis?
The consensus is a strong, unanimous strong buy. The price targets are incredibly high. They're ranging from $6.33 all the way up to $9.50.
Wow.
You see names like H.C. Wainwright maintaining a buy rating with a massive $9.69 target. That implies a potential 498% upside from current levels.
That kind of target requires absolute conviction.
It requires conviction that OGM is on the cusp of becoming the standard of care.
And that kind of astronomical upside potential, it always breeds speculation. Are there any rumors swirling around that are contributing to this intensely bullish mood?
There are. They're unconfirmed but pretty persistent rumors that point to potential M&A interest.
A buyout.
Yeah. The proprietary OGM technology is viewed as a highly valuable strategic asset, especially with the wave of consolidation we're seeing across the broader life sciences and biotech sectors. Acquiring that tech, the installed base, and that new revenue stream from the CPT code, well, it would be a transformative move for a larger player.
Yeah.
This raises an important question, though. We've been incredibly bullish on the future, but we have to analyze the bear case. What are the top risks that could derail this entire thesis, even with those strong catalysts?
Okay, the primary risk, as always with these early-stage growth stories, is financial execution. Risk number one is that top-line contraction we mentioned, the full year 2025 revenue being flat, maybe slightly down. You combine that with the crushing negative $74 million in losses, and it means they have zero room for error in executing this pivot to consumables. I saw one bearish source cite a lack of meaningful sales, which is really a critique of the top line right now.
And that critic is basically ignoring the momentum we saw in Q3 and the guidance for Q4, and they're just focusing on that full-year lag.
Precisely. And then risk number two for me is the technical downside pressure. While we see these massive long-term targets, those short-term technical indicators still flash strong sell signals. And that 30-day forecast low sits at $147 in. So investors buying today are facing some significant volatility and potential drawdown while they wait for this story to finally play out. You need high conviction and you need patience.
We have to acknowledge those risks are very real, and they are why the stock is trading where it is. So are these risks already fully priced into the current sub-$3 share price?
Oh, they absolutely are. The current valuation totally reflects the market's discounting of the current losses and the significant execution risk here.
And this is where the robust counterargument comes in. The risks, they're manageable. They're manageable because the business is actively pivoting toward that high-margin, consumables-driven model.
Right.
And that shift is heavily supported by the 47% reimbursement tailwind we've hammered on, and crucially, by that large captive installed base of 387 OGM systems.
That base isn't going anywhere.
It doesn't disappear. It continually demands recurring flow cell revenue, and that revenue is now exponentially more profitable thanks to the CPT code change. The foundation is built. The utilization is about to spike.
So what we have is a company with painful current financials, but an undeniable operational pivot. And that pivot is backed by massive clinical validation and, maybe most powerfully, a government-mandated reimbursement increase that fundamentally changes the entire economic viability of their technology.
That synthesized view of the risk-reward profile leads us to our final score for Bionano Genomics. Based on the fundamental research, the analyst conviction, and the overwhelming strength of the long-term catalysts, the overall bullish score is a very strong 8 out of 10.
An 8 out of 10. That indicates high conviction in the thesis. So lay out the final summary for our listeners. What is the elevator pitch for this opportunity?
Bionano's OGM platform is just. It's superior technology. It's transforming structural cytogenomics. And this platform is now significantly fueled by two core drivers. First, that 47% reimbursement increase, pushing the test payment to over $1,800.
And
second, the successful growth of their installed base, now at 387 systems, which guarantees that high-margin future consumable revenue.
So the near-term revenue softness is simply noise compared to the fundamental economic acceleration that's coming in 2026.
Precisely. The analyst consensus of strong buy, with targets exceeding $7 implying 280% or more in upside, it completely outweighs that near-term softness. Because the business model pivot isn't just reducing cash burn, it's positioning them for a real inflection point in profitability, all driven by that CPT code.
So this is not a quick trade?
No, this is a multi-year hold.
Multi-year hold, waiting for the full ramp-up of that reimbursement increase and the subsequent earnings catalysts that will follow. It's fascinating how a single regulatory decision can instantly redefine a high-risk biotech's entire investment case.
It's a perfect example of how policy and clinical validation converge to create a market opportunity. And for you, the takeaway is always track those critical reimbursement codes because they're often the most powerful financial catalyst in all of health tech.
A truly fascinating deep dive. Make sure you subscribe right now so you don't miss our next deep dive into the markets.